Hello, my name is Matthew Iak. I am the Executive Vice President and General Partner of U.S. Energy Development Corporation. We are a company that specializes in traditional upstream, which is the exploration and production of oil and gas reserves, as well as a focus on some of the renewable industry as well. And it is our mission and purpose to try to bring the best direct investments in the energy space to the investment public. So it's interesting, the Opportunity Zone tax law, when designed, I think most people looked at it as an investment for real estate, an opportunity to participate in real estate. But the tax law is a much broader tax law that affects a litany of industries, including the oil and gas industry. And I think, unfortunately, not enough companies have taken advantage of what I deem to be probably the most powerful tax law generated in our lifetime, maybe as much as the Roth IRA. It in essence is a super Roth concept where you can put capital gains and turn them into tax-free returns after 10 years if you invest in a sector and follow the rules of the Opportunity Zone law. So I think it's a shame that it hasn't been utilized more by energy companies and especially by the investment public to take advantage of the tax law through the energy sector. But it's also advantageous for companies like ours who have been taking advantage of it, and it's less competitive, right? So we haven't had a rise in competition on the assets or competition for selected assets. And I do think it's very bifurcated by area. So areas like the Permian, which have massive opportunity zones, tend to work very well, whereas some other areas like the Marcellus Shale in Pennsylvania and Ohio may not have as much overlap with the Opportunity Zone tax law. So I think part of it has to do with the states, whether they're blue or red. And I think a lot of the red states had more of a rural tint to it. So in the red states, you tend to see more opportunity zones overlap better oil and gas reserves. I don't think planned. I think it had more to do with the blue versus red state and ultimately where those opportunities, and because there's more than enough economically distressed census tracts in all states. The question is, was it mostly urban or rural? And I think in the states that did a lot of the rural areas, like Texas and New Mexico, you get a lot of overlap with oil and gas. So it's interesting, as I mentioned loosely, that I don't think enough companies are taking advantage of it that raise capital. And I think it's because they don't understand the power of the tax law. I think when you realize that the ability to create tax-free returns is even more powerful than the traditional benefits that people associate with oil and gas, I think that ultimately people are missing one of the greatest opportunities in history. And I hope that the industry does catch up and that it's more of an asset class that's utilized, especially as people see the arbitrage in the return profile that's available in the energy sector right now, as in direct contrast with a lot of highly appreciated assets in other sectors. It's really an out of favor sector, which creates a better arbitrage for an underlying investor. Yeah, so I loosely mentioned that unfortunately, based on each state's choice of where those opportunity zones, every state doesn't have the same oil and gas opportunity. I would say overwhelmingly, on initial blush, oil has more opportunities in opportunity zones than natural gas. It's not 100% the case. Every state can be different, but I do think the propensity towards the heavy oil states being more Republican, which tended to do more rural areas, has benefited the oil sector more so than the natural gas sector. It's not 100% true, but I do believe it's easier and has a much broader 30, 50% of all assets might fall within versus 15 or 20. So it's an easier way to comply with oil than it is with natural gas. Not from a tax law perspective, just from the overlap of location versus opportunity. So it's interesting. There's so many different types of the energy sector of ultimate investments, right? You have investing in oil and gas wells. You have investing in raw land. You have investing in mineral or overriding royalties, all the way to pipelines and then refining, right? So there's a big sector to talk about energy. And the Opportunity Zone tax law is much bigger than anyone really thinks about because you can open almost any type of business in an opportunity zone, except for the 7 listed entities that you can't do, like adult entertainment or liquor sales. So you could probably do most oil and gas. The easiest to comply with is new drilling. Because just very simply, when the tax law reads that you can either substantially improve something or you can use its original use is drilling. So to drill a new well automatically complies with original use. Just makes it really easy from an investment perspective of complying with the law. Right? It also generates a lot of revenue, which is meeting all the intent of the law, which is increasing the tax base and the value and everything else that goes into the opportunity zone tax law. So pipelines can get a little bit more confusing because it has to be put into service new, it can take a longer period of time, and it might run outside of an opportunity zone in its length. So it's not as easy to comply. It can work, it's just not as technically simple. So when you look up and down what they call the downstream, upstream, and midstream, the upstream is probably easiest. Refining and downstream could also work. Midstream's a little harder, but they can all technically go within opportunity zones, including mineral rights, because the rights themselves are deeded title property inside of an opportunity zone. So really it's a much wider spectrum than even we apply it in our world at US Energy. It's a really open spectrum of what you can do inside of opportunity zones. So it's interesting from a tax law perspective, when you think of things like real estate 1031 exchanges, you can't get both a 1031 and an opportunity zone. Right? The two laws in essence are washing, it's one or the other that you're taking advantage of. In oil and gas, it's somewhat true that you also can't get the upfront benefits that some oil and gas structures like drilling funds take advantage of, which is those huge intangible drilling costs, depletion and depreciation that give people upfront write-offs. Because in an opportunity zone law, when you transfer money in, you're only transferring the gain of an asset. So let's take a hypothetical $200,000 investment that had a $100,000 original basis. You're only moving the $100,000 of gain, and you're taking the $100,000 of basis as liquidity and avoiding taxes on the gain. Right? That's the asset that's coming into the opportunity zone. Along with that, the way the tax law read is your basis from that $100,000 drops to zero on the outside. So it's called outside basis from tax law. If I don't have basis, all those tax benefits I get, I can't use because I don't have outside basis. So you don't lose them. What happens is they carry forward within the fund to offset future distributions. So basically you're creating your own gain and loss where you're able to generate tax-free revenue from the investment, but you're not getting it day one that you would in something like a drilling fund where you take that tax deduction. So I would say it shifts the benefit. Right, from the upfront to the ongoing tax-free revenue. It's just a shifting of that, but you don't lose it. So you are getting it, you're just not going to get it in a way that you might have been accustomed to if you understood traditional oil and gas tax law. So I think one of the major flaws in the original execution of opportunity zones is people assume they were real estate and they assume they were a competitor to 1031s. The reality is opportunity zones in general, not just energy or real estate, work better than a 1031 in a select few cases. And specifically, it's when a client has a very high basis to their value. So hypothetically, if someone had a $5 million property with a $4 million basis, to do a 1031, they have to transfer all $5 million to continue to defer the taxation on their gain. In an opportunity zone, they could sell the asset and only move $1 million into an opportunity zone and keep $4 million liquid. So in the case where clients have a high basis to value, opportunity zones may actually be a better tax law. Now, you gotta worry about the underlying investments, of course, but tax law might be more beneficial. The problem is most 1031 exchanges are done when people have a zero basis. So now all of a sudden it's really not a competitive asset. And I think there's been a misnomer that opportunity zones were really meant to be an alternative to 1031s. I think they're not, except in the cases I described. I think where opportunity zones are is they're really a super Roth. They allow wealthy clients to take capital gains of all sources, stock options, sale of securities, 1231 gains inside of their business, sale of their business, and take those gains and put them into tax-free growth vehicles. So they're deferring the tax, which isn't the single biggest benefit. The real benefit is after 10 years, the asset is 100% tax-free. There's no recapture of depreciation, gains, revenue, you name it. So to me, it's a super or a mega Roth for investors to take advantage of. And in oil and gas, what's unique is it allows us to do something different than we've ever done, where instead of just distributing cash flow, you cap your distributions at, let's say, a hypothetical 5 or 6%, and you reinvest all the proceeds into more wells or more properties or more pipelines or whatever it might be, and you're growing the asset over 10 years. Where most people think of energy more as a depleting asset, in an opportunity zone fund, you're compounding that huge internal rate of return over and over and over again in a 10-year cycle to really grow the value on the backside. So it looks more like real estate than it does oil and gas, but unlike real estate, it generates cash flow very, very quickly, because you drill those wells and get cash flow in 3-6 months, whatever it might be. So you're able to generate cash flow, avoid taxes, and get this super tax-free account. So again, I think it's an amazing tax law. I can't believe more people haven't utilized it, but I think it's because the market doesn't understand that it doesn't just apply to real estate. It applies to businesses, oil and gas, you name the sector, you can probably take advantage of the tax law for your own business, no less just for an investment in something like real estate or oil and gas. So it's tough to predict the future with tax law because things constantly morph and shift. One of the interesting things is this was a bipartisan law. And I'm not saying all sides are happy with what's resulted, but I think when the Democrats and Republicans came together on this bill, I think they came out with something really, really good that benefits all parties, and it stayed relatively out of the reconciliation bill and out of politics through this last cycle, which makes me confident that it's going to continue to stay out of the politics, and hopefully we'll just make improvements in the law itself. And the idea is to generate revenue in impoverished areas. And I don't care what the sector or the market is, and I do think there's some improvements that have been mentioned in different House bills that hopefully will come to fruition, like making this more permanent and allowing the tax deferral to be a rolling 5 years. And I think there's going to be trade-offs to get that done. So from conversations I've seen and had with Washington insiders, the trade-offs would be things like better reporting and going more to the purpose of what the Democratic side of the law was, which is what is the economic benefit? How are you creating higher taxation and higher wealth in those areas? What benefit are you doing for society? So I think it'll come with more reporting, and also, especially on the Democratic side of the aisle, they'd really love to see the census tracts alter, to have to follow more recent census tracts, that people aren't finding diamonds in the rough of already pre-gentrified areas of census tracts, right? I think a lot of people feel like too many developers have taken advantage of what was already going to be developed and happens to fall in an opportunity zone versus bringing money into an economically impoverished area. And it's really on the real estate side specifically that they would like an adaptation of that to be more about actually creating more gentrification, more wealth, more economic activity in those zones, right? And ironically, of course, they didn't want oil and gas to apply. But we do generate a lot of wealth in those areas and jobs and permanent. So I think ultimately, whether or not they like our sector or not, we meet the intent of the law. So that's my 2 cents on what's likely to come is more of a permanent, rolling 5 years and making this law more permanent, and then making it more of a heavily reporting functionality, which it should have better reporting, quite frankly. I would recommend for anyone who wants to find out more about oil and gas, 1031s, opportunity zones, the tax law in general, not just our company, please visit our website, usedc.com. Please contact me or any of my staff at US Energy. Hopefully this was educational, and we really want to provide content and help people understand that this is an investment tool that is probably the most powerful tax law ever drafted and should be utilized by really all of our wealthy clients, whether it's in our sector or in another sector. Finding a super Roth and creating tax-free wealth in the future is going to be the hardest thing to find. It's something we look for all day long. So understanding this investment tool, I think, is ultimately imperative to financial planning.